Hey everybody, welcome to Managerial Accounting, Chapter 14. So I want to cover several things about how we account for inventory in this chapter. It can be a little tricky, but this chapter is super important for you to understand so that you can go forward with managerial accounting. So please reach out if you have any questions after going over what we covered today and working through your homework and all that good stuff. All right, so first of all, remind me again why we're doing this. What is the purpose of managerial accounting? So we had financial accounting in 101, now we're in 102. As we've talked about, it's very important for internal users in managerial accounting because we have useful information. And here are three of the tasks that it will aid managers in doing. So first of all, it helps determine the cost of an organization's products and services. So while the external users care about whether or not we make profit, managerial accounting is really focused on, how much does it really cost us to make the goods that we're selling? How much is each individual one? Maybe we have several things that we're offering, not just one product, and we need to compare how much each of those costs. So what we're going to look at today is really looking at how much each item that we are producing costs. It helps us to plan future activities. So once we know this information, it can help us to decide whether or not we should go forward with it. Should we find a cheaper supplier? Should we maybe push some of the manufacturing outside of the company? So planning for future activities. And we always want to compare actual results with our planned results. So we always want to do that. You can't just plan things and never compare to make sure it worked out okay. So financial versus managerial accounting. I'm not going to read through all of this, but it talks about the different focuses and the nature of how they differ. So we already talked about before that the users for financial are all of the external people. We've got investors, creditors, and anyone else, any owners or anyone outside of the company. Managerial, we're talking about managers, employees, anyone who's going to make decisions about future activities, anyone who had any part in making decisions that we've already made. So we know it helps the internal users, the managers in managerial accounting. And we do have to report according to GAAP, generally accepted accounting principles, for financial accounting. But in managerial, we do not have to do that. So we can have separate financials internally so that we can break it down and look at it differently if that's what we desire. So I'm not going to read through all of this, but it is something you can review if you'd like to. So we're going to talk about different types of costs today. We want to make sure our managers know what all of the costs are included with producing a product and whatever it is we are selling. So the first classification of cost is fixed cost. So these costs do not change regardless of how much activity we have, whether we are producing 10,000 units or we are producing 500 units, it does not change. So think about for a minute what might be an example of that, and we're going to talk about examples in just a minute. So something else that's not the same as fixed is going to be variable cost. So these would change in proportion to the volume of activity. So depending on if we make 10,000 or 500, these costs are going to vary, and we'll see an example of that in just a minute. Direct cost, now these can fall under fixed or variable and then under direct or indirect cost. So they can fall under more than one classification, but direct cost, you can easily trace that to a single object. So I know exactly how many of blank I used in producing this product. Where indirect cost cannot be easily traced. It's something that is, it's really just hard to identify how much of something went into making each individual product. Speaking of products, next is product cost. So this is necessary just for making the actual product that we are selling. Not everything else that goes on behind the scenes, but actually goes into making this product. Period costs are non-production costs, such as selling and administrative. So yeah, they're important to keep our business going, but they are not going to go directly into whatever the product is that we're selling. So we're going to look at each of these classifications and talk about examples of each one. So first, fixed versus variable. So a lot of people, the first thing they think of with fixed cost, and same for me, is any kind of rent or payment on a building. It doesn't matter how much I use that building, I still have to pay the same amount of rent on it. Doesn't matter how many units I produced. During COVID, if they shut down their company and sent their employees home to keep them safe, they still had to pay the rent, even if they were producing zero, right? Or if they come in, they say, hey, we've got this huge order, rent is still the same amount. So we call that a fixed cost. And there are several other things like that, one of which would be depreciation. Depreciation is the same amount regardless, assuming you're using straight line depreciation. So a depreciation on a building for sure. Variable costs, it would be all these things. I'm not sure what they're making in this picture here, but I think it's bicycles hanging upside down. Sorry, how did I not see that? It's all about the angle you look at something. But they're making these bicycles, and each one has how many handlebars? One set of handlebars, right? So if I make 500 units, how many handlebars am I going to be using? What's my variable cost there? I'm going to be using 500 handlebars. If I make 10,000 units, I'll be spending the money to buy 10,000 handlebars. So variable, it varies depending on how many units I'm making, what the volume of production is. Then when we have direct versus indirect, those tires that are going on that bicycle, it is very obvious how many tires are going on each bicycle. I'm going to be putting 2 tires, 2 wheels, 1 set of handlebars, 2 pedals. It's very clear and very direct. I need to assign the cost of 2 tires to the bicycle. Whereas something like electricity, how do I say this bicycle took exactly this many watts of electricity to produce it? I don't know. I don't know the answer to that. I don't know exactly how much electricity it took. So for that reason, I'm going to have to take my electricity bill and spread it out amongst the different departments and the products. And then we get to product cost versus period cost. As I said, for product cost, it's all the stuff that goes into making that bicycle or whatever you are selling. So we know that the seat, that's a product cost. The tires, the wheels, the pedals, all of those go directly into the product. Now, that doesn't mean that's the only expenses that we see. You know, even the electricity in the building where we're making this would go into the product. But we had some advertisement for those. I know there's some bicycle place, I think it's in Spartanburg, where there's a giant bicycle on top of the building. Well, that cost them some money. That money didn't go directly into making a bicycle, but that was good advertising for them. So that would have been a period cost. Now, the reason these costs are important is because the product cost is going to go into inventory. The period costs go into expenses directly on the income statement as soon as you incur those expenses. So product costs get to go onto the balance sheet until we sell those items, and it's going to be under inventory. Once we sell them, it'll move over to cost of goods sold, as we'll walk through later on. For advertising, selling expenses, commission for our salespeople, you know, anything that's going into the sales office, supplies, copy paper, all of those expenses will just go directly on the income statement. They were great to help us do business, but we can't wrap that up into inventory for our product costs. So as you see here, each item that we are going to have as a cost is going to fall under one of each of these classifications. So we talked about the tires and wheels. So they're going to be variable. Depending on how many bicycles we make is how many tires and wheels we use. They will be direct, as we discussed. It's very clear how many go on each bicycle, and that is clearly a product cost. Not everything's quite as straightforward though. Let's see, for advertising, it may be fixed. If you're spending the same amount on advertising, maybe you have the same ads that run every month, that could be a fixed cost. There could be an argument for it to be variable as well. That is an indirect cost. That is not one that says this bicycle had exactly this amount of advertising. We sold this many and they each cost this much in advertising. No, we're going to just kind of have to spread it out amongst all of our products. And as I said, that's a period cost that did not go directly into the product either. How about depreciation? I told you it is fixed, assuming that it is straight line depreciation, and it is indirect. I can't say, okay, my office depreciation is going directly in, or this much going for each product. And since this is office depreciation, that would be a period cost. That's going to go directly in the income statement. But factory depreciation, so I am building these bicycles in this factory, that can actually be a product cost. So see, the period cost had to do with the office where they're selling, they're doing all the paperwork, whereas factory depreciation could be wrapped up in the product because that's the building we're using to manufacture that bicycle, those bicycles. How about oil and grease that you apply to the gears and the chains? That's variable. Okay, it depends on how many bicycles I'm making as to how much oil and grease I'm going to use. It's indirect because you know what? This guy over here puts way more grease on than this girl over here. So even though we both are using 2 tires on each bicycle, she's using an extra teaspoon or 2 of grease. Maybe you don't measure grease in teaspoons, but you know, that's all I know. I don't know how to put a bicycle together. And it's an indirect cost. And then it is also a product cost. So while we are not sure exactly how much everyone's putting into it, we do know it's going directly onto the product. So I'm not reading through all of those, but that's a good bit of them. So when it comes to manufacturing, so we are making a product, our costs are going to be direct materials. So anything that we know, like the bicycle tires or the pedals, those are materials that we can clearly identify how much of each material goes into each product. Direct labor, now let me tell you, direct labor for manufacturing, that is the people who are hands-on putting that bicycle together. If you were making cupcakes, it's the people who are hands-on mixing up the cupcake batter. That is your direct labor. That labor gets wrapped up into the inventory cost. Factory overhead is all of the stuff that is indirect. Indirect labor, which would still be people that have something to do with producing the product, but they're not hands-on. So they're like the manager walking around saying, get off your cell phone. That would be indirect labor, which would fall under factory overhead. What else would be indirect? The oil and grease I talked about, that's not direct. I can't tell exactly how much I'm using for each bicycle, so that's going to be indirect. That's going to fall under factory overhead. The electricity that I was using to run the warehouse, to have the lights on and the heat on, that would be indirect. You know, we know that it has to do with the product. We had to have the lights on to make the product, but I don't know exactly what the wattage was for each bicycle. And then there's things like the depreciation, that's indirect. So that goes into factory overhead, assuming that's factory depreciation or depreciation on a machine that you are using to produce the goods. So then you can see it, a lot of times the labor for manufacturing is going to be one of the smaller numbers. This is just an example. Direct materials is probably going to be a pretty big expense. And then factory overhead is going to be a big portion of it as well, because you have a long list of items that are indirect that fall under factory overhead. And then those non-manufacturing costs, the period costs are selling expenses and administrative expenses. We've already talked about that a good bit. Okay, the 3 inventories. This is so important, and I love to do a demonstration to show you what the process is for each of these. So I'm going to do that separately outside of this video. But the first thing is raw materials. When we think of raw materials, we think of, let's say, the bicycle. We have all the parts for the bicycle. We've got the tires, we've got the pedals, we've got the bolts, we have the spokes. But right now, those are just piles or just boxes. They're great, and they're something we have going for us. But until we put them together, they're just raw materials. So it's inventory. We have the items in inventory, but right now they're not a product that we can sell. Our job is not to sell pieces of bicycles. Our job is to sell bicycles. So raw materials are all of those loose pieces that have not yet been created into something. Work in process inventory is going to be when we start taking all those pieces of raw materials and putting them together, but they're not finished yet. So we're taking the pieces, we are forming them into something, but we don't have a finished product yet. But that's still inventory. It's still something good we have going for us. Finished goods inventory is the bicycles that we have complete. We have them sitting there ready to sell. We can put them on our showroom floor. We can list them on eBay or Amazon or whatever our website is. Those are finished and ready to go. So if this was an external user looking at inventory, we would have all this in one line item, just inventory, and it would have an amount beside of it. But for managerial, for internal users, we want to list these out separately because we want to know how much do we have in raw materials, how much do we have that are partially completed, work in process, and how much do we have that is finished goods inventory. So we have them all listed out separately, but they are all inventory accounts. So hopefully that you can understand what I'm talking about there. All right, so how about when we're trying to figure out cost of goods? If we have a merchandiser, that's somebody who buys items probably in bulk and then resells them at a higher price. So if we want to figure out the cost of goods sold for a merchandiser, we take the beginning merchandise inventory, however much we had in inventory in the beginning, plus any goods that we purchase, the cost of those goods, and then we subtract out ending merchandise inventory. And that would bring us to our cost of goods sold. So basically, these first two are the costs of goods available for sale. And then we subtract out what we still have sitting on the shelves, and the difference is the cost of goods sold. These are the prices we spent for these. That's the money we spent, not the money that they paid us for. That would be our revenue. But these are our costs for the goods that we sold. Now, if it's a manufacturing company, a company that actually puts the bicycle together themselves or whatever item they might be selling, we're going to take our finished goods inventory. We had 3 different inventories. This is just the finished goods, plus any cost of goods manufactured, any more that we finished, all those costs, minus our ending finished goods. So again, these first two are goods available for sale. These were all sitting on the shelves, hypothetically speaking, ready to sell. We started out with several bicycles. We finished some more. These are all sitting there on the shelves, ready to go. And then we still had some left over at the end that we did not sell. So that difference would also be the cost of goods sold. So here's how those manufacturing costs could actually look. So for this company, Rocky Mountain Bikes, this is their schedule of cost of goods manufactured. So again, we have the direct materials. This is all of those raw materials. They started out with a bunch of boxes of loose items to put together for a bicycle. They purchase additional items. So total, they had $94,500 worth of raw materials, pieces ready to put together into a bicycle. Then we have the raw materials ending inventory. See, we started out December 31st, 2018. That's our beginning when we went into 2019. And then we have December 31st of 2019. So we still had $9,000 worth of raw materials sitting on the shelves at the end of the year. So we subtract that out to see that we used up the difference here. We used up $85,500 worth. We had $94,500 available, but at the end of the year, we only had $9,000. So the difference must be how much we used. Then we're going to add in $60,000 of direct material. I got these from the different time cards of people who were actually hands-on putting those bicycles together. Then we calculate the long list of indirect factory overhead costs. So all those indirect things that relate directly to manufacturing the product are going to fall under factory overhead. So you can see indirect labor. Again, that would be the supervisors who are on the floor where they're making the bicycles. The factory utilities, not the office utilities where the salespeople are, or the showroom floor, whatever, but the factory utilities where they're actually being made, repairs on the factory equipment, that's important, property taxes on the building that they're making the bicycles, factory supplies that were used, insurance that expired, depreciation on the factory assets, amortization on the patents of factory equipment. All those indirect costs that did go into making the product ultimately are added together to tell us our factory overhead was $30,000. So we add together our direct materials that we used, direct labor that we used, and factory overhead we used to find the total manufacturing costs. Then we add that to our work in process inventory at the beginning of the year, or the end of last year, same thing. That tells us the total cost of work in process. And then we subtract out whatever was still left over in work in process. There were still some bikes that we hadn't finished at the end of the year, $7,500 worth. That then gives us the cost of goods manufactured, the cost of finished goods, in other words. So we put all of that into it to see how much was the cost of the goods that were finished. I understand that was a lot of information on that sheet. Maybe listen to it again, maybe read through that portion of your book, but reach out if you have questions on that. We're actually almost finished here. Just got a couple more things I want to cover. This is the same thing we just covered, but we're just talking about it definitionally speaking, not having the numbers. So we took the direct materials used, as you recall. We took the direct labor and the factory overhead. There were just long lists of some of these things. That gave us the total manufacturing cost. We added in any beginning work in process, subtracted out anything that was still in work in process at the end, and that told us our cost of goods manufactured, which is the same as the cost of finished goods. All right, one more thing I want to cover in this chapter is just-in-time manufacturing. I'm not going to get into this much, but it's important to know that JIT, just-in-time manufacturing, is a way that some companies would use to not have much inventory on hand at all. So basically, once they receive that customer's order, they then schedule production. They receive the materials to produce it just in time for that production. They complete the parts just in time, and then they complete and finish the goods and ship them to the customers just in time. So that's why they call it obviously just-in-time manufacturing, because they don't want to have any extra inventory on hand. They're waiting for someone to actually need that exact product before they have them on hand. Or some companies may have a small amount on hand, but they do not keep large quantities at all. So that's just a tiny glimpse into just-in-time manufacturing. This was a lot of information in this video. So again, read through your book, work on your homework, but let me know what questions you have after trying to complete them yourself.